The broadcast is now starting. All attendees are in listen-only mode.
This is Danny Bobrow, President of AIM Dental Marketing, welcoming you to this installment of the Practice Perfection Web-Based Education Series. Today's presentation is entitled Plan to Prosper, 10 Simple Steps to Sail into Retirement. Ted Schuman is President of Dental Business Services, also known as the DBS companies. DBS delivers reliable accounting, tax, financial, and estate planning, practice brokerage, and practice management services for dentists. Regardless of where you find yourself along your career path, planning for retirement can be the most important exercise you will ever perform. Properly planned and executed, it can mean the difference between happiness and fulfillment and frustration and disappointment. Simply put, you've worked too hard not to reap the benefits of that work. By the time we're done here today, Ted will have presented the retirement planning process and how qualified plans support it. You will receive an in-depth understanding of the use of Roth contributions to a 401k plan, learn about the various qualified plan options available, and how to maximize your contributions to your retirement plan, as well as illustrate optimal withdrawal strategies from your qualified plan for both lifestyle and tax advantage purposes. Ted will show you how to plan for the financial and lifestyle aspects of retirement, Social Security's role in your plan, and creative cash flow generation tactics to assist in your retirement plan. In short, Ted will show you the way to Freedom Day, when you will no longer need to work. Now, before we get to today's event and very special presenter, I want you to know that Practice Perfection webcasts run for around 90 minutes. While attendees are in listen-only mode, we invite you at any time to submit your questions or comments using the question button on your screen. We will allow time following the presentation to get your questions answered. If we should not get to your particular question during the webcast, Ted has assured me that he will see that they are answered personally shortly thereafter. Attendance at this presentation entitles you to receive 1.5 hours of continuing education credit. Shortly following the webcast, you will be emailed a brief survey with instructions on how to receive your CE. Participants are cautioned about the dangers of incorporating techniques and practices into their, procedures. I got to get this right because it's the PACE approved disclaimer. Participants are cautioned about the dangers of incorporating techniques and procedures into their practices if the course has not provided them with adequate clinical experience to allow them to perform it competently. Notwithstanding that I don't think Ted is going to be speaking a whole lot about clinical content tonight. In any case, and especially, it's my distinct pleasure to welcome to the Practice Perfection stage, Mr. Ted Schuman. Hello, Ted.
Hey, Danny, thanks so much for what was a very nice introduction, especially that stuff about the PACE stuff. You know, that was real heartwarming. I like that.
I thought you liked that.
I'm going to get started here. I do want you all to know one thing, and that is I'm an old guy. And today I had to go, periodically I have to go in for fluids. So I had 4 hours of fluids today. So if I tell you about halfway through, I need to take 2 minutes, you'll know why. But hopefully we'll pass through that. But anyway,
other than that, it'll be a fluid presentation, and yes, we will pass through that.
And it will be dry. That's the important thing. So,
all right.
Anyway, we're just gonna. I don't like to go to seminars where you have a half hour or an hour and a half of commercials about the company. So I'm not going to do that. You can see what we do up here. The one thing that I am very proud of is the fact that we are endorsed by the Michigan Dental Association for investment advisory and financial planning services. So I think that's fun. I've been doing this about 35 years. I think Danny and I started working with dentists about the same time. So he's a lot younger than I am, right?
A little.
So we're going to talk a little bit about retirement planning process. We're going to talk about how does Social Security fit into your situation, the retirement planning. We're going to go through some actual examples. By then I'll wake you up, and then we'll get back to creating cash flow, not only in your personal life, but in your practice. And then we're going to go through some qualified retirement plan choices. And then we're going to talk a little bit about the option of using Roth in your 401k. That presumes you have a 401k. We're going to talk a little bit about withdrawal strategies. So let's get right thinking about what do we mean by retirement? Well, that's when you stop working on a full-time basis. And you can do what you want to do when you want to do it within certain limits, of course. But the thing that I think is important is some of us can't ever see ourselves retiring. You know, it's kind of a thing that I'm 63, I guess, right now, and I can't imagine myself retiring yet. And so it's a kind of a situation where it's different for everybody. You know, we're basically thinking about either an alternative lifestyle, we might call it, financial independence. And what I like to work with clients in this regard is not so much worrying about the exact date you're going to retire, but having you prepared well ahead of time so that you can retire when you want to. Because, you know, when you own a business, you can't just say, I'm giving you my 2 weeks notice and I'm out. You know, if you got a practice you got to sell and things like that, it's all going to take its own time, okay? Nice thing about being retired is you have the freedom from an occupational schedule, and there's lots of nice benefits. You no longer have to manage the practice or manage deadlines or deal with Delta Dental or the other insurance companies. You can sleep, watch TV, eat at your leisure. Now, if you're a married guy like I am, I have to put a little, qualification in there, and that is as long as it works in your wife's schedule, right? So we'll make sure we look at that. There's less to actually no stress, more time, no pressure to perform. It's all pretty good. I've had many clients over the years that have pursued a hobby or a dream, that may be sort of another business or another career. I had a client a number of years ago that was quite an artist, and when we sold his practice when he was 68, he's been ever since then. It's been about 12 years now, and he spends his life producing artwork and selling them at art shows and things like that. Still having a great time. Now, my goal, let's see, I hack at the guitar. I don't play well, but I have 13 guitars to make up for not having any experience. But I have a retirement plan because I never know if I'm going to put enough away or not. My retirement plan is I got 2 signs. And I'm going to take my guitar down to the park, and the first sign will say, we'll quit playing for $10. And the second sign will say, we'll quit singing for $20. I figure I can clear a couple $100 a day that way. So that could be one of my dream jobs anyway. You can do and work at the things you want to when you want to. If you're a woodworker or something like that, or a guy that builds kayaks, like I think Chris, who's on the phone on the call tonight, you can do those things and enjoy it, okay? You can volunteer, and a lot of our clients still remain in the mission mode after they're retired from dentistry, and they go over to various places and do dentistry and help out and things like that. And, the thing that is interesting about dentists is you guys are the smartest kids in the room, okay? You can't be a schmuck to get into dental school. So if you have a high IQ, then just going home and sitting on the porch and rocking isn't going to work for you, okay? So you have to have something that's as relevant to you as was the practice of dentistry, okay? Now, of course, there's other nice things. If we don't have to pay Social Security tax or Medicare tax anymore, that's kind of nice. There are some drawbacks to retirement. One of them is boredom. I have found a lot of my clients have done a good job of planning for the financial aspects of retirement, but some of them have not done as good a job of what am I going to do with all this time on my hand, and they get bored. In fact, I had a client a number of years ago. We sold his practice at age 70. 3 years later, he was back in practice someplace because he was so bored and couldn't do anything else. So you got to know what you're going to do with that time, okay? The next drawback, I don't care how much money you put away, it's very, very difficult to have as much cash flow in retirement as you do as you did when you were working. So you have to make some adjustments there. Probably the single biggest thing that I hear from doctors who are clients of mine who have retired or who sold their practice or whatever is that they miss the social interaction with their patients, and all of that status and power that comes with being doctor, So that was, that's kind of a tough thing to give up, okay? Some people actually get real down and they start feeling useless or unproductive, okay? And then that inactivity it could affect your health. I have a real good friend of mine. When I feel the need to work out, I call him and he talks me out of it. Now that's a good friend, somebody that'll do that for you. But now the other problem is you have to pay Medicare and probably your own health insurance unless you were lucky enough, like I was, to have a spouse that worked at a job that she has lifetime benefits. So we get medical insurance and things like that. Now, this is a problem for your spouse. You're going to be home all the time. Okay, you'll see in our little cartoon there that that we've got the tape or the paint kind of showing which side is hers and which side is his, and so that's a lot of truth. Well, often when you think about it in your married life, the number of hours that you spend with your spouse can be somewhat limited, and then now you get in and start screwing up the process a little bit because you're there all the time. Okay, so you got to think about this. What am I retiring to? Okay, are you ready for a month of Saturdays every single month? Okay, I'll guarantee you the first few months you're gonna go, man, this is awesome. Why didn't I do this sooner? But eventually you can only play so much golf. You can only fish so much. You can only climb so many mountains, right, Danny? Whatever it is that you're doing, okay, you have to find things that are relevant for you to do. Okay, so let's get right into the retirement planning process. And first of all, there's a lot of guesswork in retirement planning. Okay, we have to know a lot of things that we can't know. Okay, so the first thing we do is when we're starting a plan, we have to figure out, when do you want to retire? Okay, now we don't want that date to be so etched in stone that it can't be flexible, because as I said, if you're selling the practice or something like this, that could be a problem. But we have to have a date that you're going to look at. Okay, so when do you want to retire? Then you're going to have to figure out, what does retirement cost you, including taxes, because the downside of our world, no matter what, even though we've got a little bit lower tax rates right now, is that taxes will continue on. Okay, and so you're going to have to figure out what assets that you have to fund retirement. And a lot of times we'll go through a net worth statement with a client, and they have a very high net worth, but unfortunately, I did one about 3 months ago with a client. Net worth $3.5 million, invested assets $1 million. So we got houses and cottages and boats and things like that, all that are not really assets. Those are expenses that we have to keep up. But we have a nice net worth, so we have to identify those assets that are going to fund your retirement. And then we got to make some guesses or some assumptions. We got to know, okay, what kind of return are you going to get on investments? Now, one of the problems with returns, every software that I've ever worked with shows a linear return. So in other words, you're going to get 7% a year, every year of your retirement. Well, that's not realistic. You might have 2 or 3 years where you're above 20%, and then you might lose 15% or whatever. So having that assumption is a guess, and so we have to be sort of conservative in that area, okay? And then we have to know what your Social Security benefits are, and we're going to talk about that in a couple of minutes. And then the pension benefits, if you or your spouse worked anyplace else and you earned a pension, then we want to know what that is, okay? And then the inflation rate. Now, often when we're doing calculations for clients, the inflation rate throws the calculation to the point where some people get disgusted with it and say, to heck with this, because I'm never going to get there, so I'm just going to enjoy my life. I'm not going to put anything away. Well, you can understand that, and so we have to figure out what is the inflation rate. Typically, we might use a 3% inflation rate, and again, that's not linear either. So we've had a number of years where the inflation hasn't been too bad. And then we have to figure out, how long are you going to live? Now, I happen to know one thing, and that is that it doesn't matter when I die, because when I die, the world ends. Because I can't imagine the world being without Ted Schumann. It's impossible to even contemplate, right? But we have to think about this. Now, truly, life expectancy in my family is not too good. Between my mother and father and both their parents, the oldest was 74 when they died. So it's not I don't have a good look at good. So then we have to make some retirement calculations, and you have to determine if you will need to modify your expectations after the calculations. And more often than not, this is kind of a moving target. And sometimes we do have to rework the numbers and say, well, what if I did this? Or what if I did that? Or, all of that kind of thing, okay? So then once you get that number, then you begin implementing your plan. So we know that the earlier you start saving, the sooner you can retire. The saddest calls that I get a couple, 2, 3, 4 times a year is a guy that's about 64, 65 years old, said, I think I want to sell my practice so I can retire. And then I start talking to him about what he has in addition to the practice. And the answer is somewhere around $200,000. Maybe if he gets 400, 500,000 for the practice, and then Uncle Sam takes their little cut of it, maybe he's going to have about 300 grand left. And I say, well, what trailer park did you want to live in? Okay. And I don't mean that jokingly, but the thing is, he's probably going to have to work mostly through his retirement. Okay. So there's some information we need. Okay. You have to understand how compounding of interest works, and also present value and future value. And fortunately, there are many, many calculators out there that you can play with this kind of information, but we have to have a concept at least. We have to know how many years between now and retirement, okay? And this is going to be, one thing about retirement planning, it is not one size fits all, okay? We don't get to go in the back room and pick up a size 7.5 retirement plan for you. Every client we work with is different. So we need to know when do they want to retire, how many years they have, and then we got these emotional issues, okay? What am I going to do with all this time? We talked about that already. Am I ready not to be doctor, okay? And some people that I know pretty well are in a situation where they call me Joe. They don't have any kind of a big deal about being a doctor, and others are very, very much, they earned that, and I'm happy whichever way they want to go. But there is a nice thing about being a dentist, and that is you're the king of your castle, or the queen, depending on I'm sure we have some ladies in the audience, and I don't mean to slight them, but so you're in charge in your office. You can tell them what time you want to see crowns, what time you want to do extractions, what weeks are you going to take off. And pretty much everything that goes, to control in your life, you can really do a nice job. It's one of the beautiful things about dentistry. We don't have a lot of late night emergencies and things like that. Now, when you retire, you become part of the recliner chair that squeaks. Okay, you're not quite as important as you used to be. I know that because at home, I'm a big dog out on the street here. I do a lot of talks, things like that. At home, I don't get much credibility. So think about that, okay? So sometimes we'll be having the discussion with clients about, are we going to just get to a cliff and we're going to say, this is it, I'm done, I'm not working anymore? Or are we going to cut back? And now the problem that we have with cutting back is that you can only cut back so far before you start to hurt the value of your practice. Now, some doctors will sell their practice and work for the buyer, and we've had that happen many, many times, and it works 90% of the time, works beautifully. 10% it's a nightmare. So we do have that coming out. Now, if you go to SSA.gov, that's the Social Security website, you can see what they expect. They've got actuaries and things like that. So these are at least okay numbers to deal with. Now, I'm right there between that 60 and 65. So according to this, I should live somewhere between 81 and 83. Okay, so we'll see how that works out for me. But actually, for most people, that life expectancy is going up every year. When my grandmother was my age, she was old, and I don't mean because I was 24 years old and she died, so it wasn't like I was a kid. But she was old. She had 10 children she raised. She was broke down, beat up, everything you can imagine. 63-year-old people are running marathons. They're doing all kinds of fun things like that. So life expectancy in our world now is much different. And most clients, we expect easily for them to live till age 90 or older. Okay. So let's keep on talking about other things we're going to need to make the decision. We got to know that inflation rate. Okay. And then what's our after-tax return on investments? Okay. And then what are our after-tax living expenses? Here comes the tough stuff. How the heck are we going to know, right? If you have any pensions coming in, we need to know that. We're going to know what your Social Security benefit is. So we start out with a budget like this, and it'll say, what's it cost me now? And what do we think it's going to cost us in retirement? Now, I will tell you that this is by far the place where most clients jump off and say, never mind. I didn't really want to go through this anyway. Or they don't know and they're not willing to put the effort into it. And so we make some guesses. And, you know, a guess is okay, but it's not going to do us as much good as we'd like to. Okay.
Well, Ted,
so
if I can, I think that's a good point. Because I just went through this with my TD Ameritrade, and they ask questions that you really can't answer because you don't know what your medical expenses are going to be.
That's right.
Right. So how do you, I mean, and you know, as Confucius said, a journey of 1,000 miles begins with the first step. So I just sort of dove in and estimated, put in the things I knew and just kind of made some assumptions. And then at least it's sort of an if-then else kind of analysis. At least, well, if this is the case, then this is what what you can expect to live off. If something else should happen, then you may want to plan a little bit more conservatively. I don't know. How do you approach that?
Well, there's a couple things. Number one, you're absolutely right. You should always go conservatively because you're never going to be mad you got too much money. Okay, that's number one. But number two, a very good financial planner, actually, he's a guy that goes around the country and teaches us how to do financial planning, actually has a process that he puts his clients through that says they have to go get a complete physical exam before we even do these calculations. And he said over 25 years, he has found 6 clients with diseases that would have killed them if they hadn't gone in for this. So we had to know that. There are also some statistics that we can look at and say, okay, we don't know exactly what yours are going to be, but we know it's going to be in this range. And
yeah, where you're going to fall on the bell-shaped curve likely.
Exactly.
That's an excellent point.
Exactly.
With the diagnostics that are out there now and the genetic testing, it really, even from a retirement planning standpoint, it kind of makes sense not to avail yourself of what's out there.
Well, you know, as you know, 8 years ago, I went through colon cancer, and I'm going to tell you something. I've sold more colonoscopies than you can imagine because that's what saved my life, you know. And so, not pleasant to talk about, but I'm still here. So we go through this process, and like I say, people get a little overwhelmed by the process, and so I usually tell them right in the beginning to expect that. You're going to get overwhelmed. It's going to seem like it's too much work, and just bear with me. Stay with it, because when we get all said and done, we'll have a plan that at least you can follow, and then we're monitoring it each year, and we can tweak it from there when we find out more stuff. Okay? So to design that budget for retirement, you got to know what you spend today. Okay? Now that is where the rubber sort of meets the road. One of the reasons why it's difficult to figure out what we spend today is that we have relatively high income, easy credit, because we have so it affords us a higher lifestyle. So sometimes we don't think about what it really costs us to live. Many personal expenses are paid through the business, and then they get forgotten. And many people don't think they have time to track, and most of them just get overwhelmed and they throw their hands up, say, I surrender, I don't care. Okay.
Well, I think that's an excellent point also, Ted, which is, and by the way, I don't normally interrupt our speaker, but I think this is so relevant. I wait until the Q&A session, but I think it's important. When you're talking about those hard to plan for contingencies, how do you help your client to actually go through that and to make it tangible?
You've got to have, the first thing with a contingency you've got to look at is, okay, if I'm still active in owning a practice, I've got to have a plan if I'm taken out of the game all of a sudden. And 2 or 3 times a year in our practice brokerage, we get that call. My husband passed away suddenly. He was 44 years old. And so what we try to talk to them ahead of time about is, look, number one, we got to have a plan. You know, I always jokingly say to my clients, to the spouse, call me before you call the funeral director. Okay, because I've got to get somebody in the practice, keep the practice going and keep the value going, and then we'll go from there. But even as unlikely as dying young, becoming disabled at a young age for a dentist is highly likely. And when you become disabled,
occupational hazard.
Absolutely. You know, you guys all cram into these god awful positions to take care of your patient day after day after day, and then all of a sudden you got neck, hands, you know, wrists, whatever. They're all causing you trouble, and eventually you can't do it anymore. So you got to have a plan. Number one, for the practice. Okay. Number two, I really nail home hard, especially when the dentist is young. Most dentists are woefully underinsured. I don't sell insurance, but most of them don't have enough life insurance or enough disability insurance. Now, I can tell you this story because he wrote about it in the Michigan Dental Journal. We have a consultant that works on our team as a dentist. Dan and his wife have been clients of mine since they were third-year dental students some 25 years ago or so. Dan ruined his wrist about 6 years ago in a fishing, not accident, but just a fishing deal. And fortunately, Dan was one of the kids that listened to everything I said, and he did it. Well, he has a boatload of money coming in from disability and will have for another 15 years. And it made all the difference in the world. So one of the things we want to look at with people when they're young or still, if their health is such that they can buy insurance, we want to make sure they have enough. Now, you think about it. If you're making $200 grand a year and you need to replace that income, okay, $1 million isn't going to last very long. In fact, I look at it just a quick back of the napkin kind of thing. From an investment standpoint, think about 40 grand per million, okay? You can take out about 40 grand a million and not touch the principal, okay? So if I've got a client that is making $200,000, I got to have 3, 4, maybe even as much as $5 million in life insurance, okay?
And I would imagine too, Ted, that should you be fortunate enough to actually retire, you touched on this briefly. I think, and I'm sure that you go through this as part of your process, the monetary benefit of owning your own business, the things that you are able to deduct, you know, that you're able to pay pre-tax, that go away when you're no longer self-employed. Yep. That also represents a major drag or increase in your expenses that a lot of people don't know how to quantify, right?
That's great. In fact, that's what we like to go through. You know, if they're our clients, we kind of know a little bit more about what's getting put through there, and then we dump those expenses back onto their budget, and they're amazed. Oh my gosh, I didn't realize I was spending this much for that or this much for whatever. Now, when we get to a certain age, the disability insurance will be maybe not necessary anymore, and we might look at leaving that. But even the life insurance, even if you're older, you may want to keep that for a longer term. But again, everybody is different. So now, when we talk about this whole process, and I'm going to talk about what you're just saying about finding those business expenses. Problem is the process is tedious. Okay, it is. You know, I tell people it's like the accounting equivalent of a root canal. It is not fun. And most of the clients, this is where we get a little ugly time with them. I want you to track your expenses for a period of 6 months, okay? And you got to go through your business checkbook. You got to go through your personal checkbook. You got to go through the credit card statements on both of them and put together a schedule of how you spend your money. Now, I'll tell you that 90% of the time they say, Ted, one of two things. I'm not doing this, or can you do it? Yeah, Doc, I can do it, but it's not going to be cheap. But yeah, you know, and so that's where we end up. But you got to go through these things, and your accountant or your financial planner can help you a lot in this process. But you got to be willing to commit to it. You know. Now I'll tell you something. By the way, in this whole planning, which I kind of neglected to say, this is the worst marriage counseling processes you'll ever go through. You're going to go through this process, and the doctor says, maybe he's a male, and he says, you know, I just want to be in a single wide up northern Michigan, and live that, live close to the land and things like that. And then she looks at him and says, "Are you out of your flipping mind?" And I say to him, "Are you out of your flipping mind?" But a lot of times we've got a lot of give and take and compromise that has to go on between the husband and wife on what does retirement look like to them. Okay. So you've got to get this scheduled. Now, you got to think about budgeting some amount for continued savings. It's kind of, maybe you're going to buy a car every now and again or things like that. So you figure that into it. And then you got to coordinate your budget with debt reduction strategies. There comes a point in time in your retirement plan where it's as important to pay off debt as it is to fund retirement. Now, when you're younger, we want you to sock as much away. In fact, I usually tell a young dentist, give me 12 years. You got to live, less, you got to lower your lifestyle, whatever, for 12 years, and then we can open it up. But when you get, let's say you're in your late 50s or early 60s, you're going to get as much bang for your buck out of paying off debt as you are funding retirement. Now, you have to design that retirement budget to be flexible. In fact, I usually like to see them in a range. So maybe at the most we'd spend this much. At the least, we're going to spend this much. So if we have a bad year, we lose a little money or whatever, then it allows you to cut expenses. Now, I don't know about cutting expenses. My daughter's getting married in November, and all I know how to do is write checks. And they tell me this goes on right up to and including the wedding day and a few weeks after, right? So I don't dare ask if this is necessary because, what are you, crazy? Now, one of the things that is very hard, and Danny, you kind of alluded to this, and that is figure out what medical expenses are going to be. One thing I can tell you, even if I don't know exactly how much they are, they're going to be more as you get older. I have a place in Florida, so we see a lot of people that are 15 or 20 years older than we are, and they all have some kind of something that they're dealing with all the time. When you fly to Florida, there are, no kidding, in the wintertime, 25 to 30 people on the plane or more that are in wheelchairs, okay? So you got to plan that your medical expenses are going to be higher as you get older. In fact, one of the things that we talk to people about is funding an HSA. Get some money aside right now in an account that's just like an IRA, and you can use that for your medical expenses, okay? Now, you're going to be required to pay hospitalization insurance out of your personal funds unless you're lucky like I am and your spouse has benefits from their job. And if not, then you're going to be paying for that. And those of you who are already buying health insurance know that it's probably one of your single biggest expenses, right? I've got some clients that are in excess of 25 grand a year. They've still got a number of kids in their program and so on and so forth. And then to make matters worse, the programs are generally set up so that the older you get, the more those benefits cost. So that can be a situation. And then we have Medicare that will kick in. So one of the things, if you're getting close to retirement, that I would strongly recommend that you do is you got to get familiar with Medicare. And because if you say, for example, like in our state, the Michigan Dental Association has a insurance agency that they own, and in that agency, they have arranged to be able to get hospitalization insurance. In fact, they really set up something very cool because it's kind of like a self-funded deal. But once you get to be 65, you're in Medicare, you're out of that program, and they will help you find a gap policy, or you're going to have to find one on your own. But so you got to get familiar with what Medicare covers and so on and so forth. And this is the area right here. People talk about Social Security. The Medicare is my bigger worry in terms of what it's going to cost eventually in taxes, because those people are living longer. They're, I don't want to say burdening the system, but they're using the system and staying healthy longer. But this Medicare deal, you're going to want to look at it. Now, if you go to Social Security's website, ssa.gov, they've got some nice discussions out there on the Medicare, what it covers, how it works, how they charge for it, and all that. Well worth your time to get familiar with that. Okay. Now, there's some expenses that we had that we formally paid through the practice. Okay. Now we're going to be paying them personally. Typical are meals and entertainment. Although the new law severely restricts what we can do with entertainment. You can probably still deduct a meal with a client or with a patient, but you can no longer buy the tickets to the baseball games or the football games or the hockey games or whatever. So that's all going to be paid personally. Okay. Then vehicle expenses. I don't know about you, but probably 90% of our clients, we take a deduction for the vehicle in the practice and take somewhere between 75 and 90% of the expenses and charge the rest back to the owner doctor. So the vehicle is going to be paid that way. You probably have a laptop or two or some iPads or whatever that you replace every couple, 2-3 years. And now you're going to have to do that out of pocket. Okay. Life insurance, if there's, yes.
Question. Would you say that it makes sense then, because, you know, I'm planning to never retire. I'm planning to graduate.
Mm-hmm.
I'd like to graduate to another role where I perhaps don't do as much or as many things, but can focus on what I like to do. And doing that would enable me to maintain my status as a business owner and continue to benefit from the deductions.
Take some of those deductions, yeah. In fact, we're seeing more and more now where if we sell the practice and the doctor's going to stay on, we'll have him stay in his own corporation and then have them pay as an independent contractor. Though there's some hoops you got to jump through to make sure you get that right, but you're absolutely right. Unfortunately, there are some people that when they're ready, you know, they're ready and they don't want to work.
Sure.
You know, they don't want to work anymore as a dentist. And unfortunately, that's the thing that they do that pays the best. You know,
that's true. But I'm wondering though, if taking a part-time teaching job or doing, I mean, potentially, I suppose, I don't know if this is true, but even driving Uber or being, there must be ways to be a business and not work as hard and not generate as much income, but still, you know, reap the benefits of these deductions, right?
Well, absolutely. When you think about it, a lot of times dentists just are bored. You know, they've done the same thing. They've really hit the pinnacle of their career. They've done everything they want to do, and now they're starting to sing that old song, "Is that all there is, my friend?" And so sometimes they'll go into an entirely different business. You know, they might go broker dental practices, or they might. Actually, it's interesting. The jobs at the university that are part-time, you can drive a Uber car probably and make more money than what they pay you there. The full-time ones are pretty good, but the part-times, I have a part-timer and she teaches 2 or 3 days a week and made about $8,000 last year doing it. Yeah.
But if it allows you to legally maintain your status as a business owner, I would ask, who cares?
Yep, absolutely. And there are opportunities out there, and the time to look for those is now. You know, don't wait till you're home and bored and things like that. Keep your eyes open for opportunities like that now. So now let's take a look at Social Security, and I'm moving us along. Just try to keep us in some kind of a order time-wise. I love this cartoon. And the guy on the left says this guy Madoff is going down. He was paying off his old investors with money he got from the new ones. And there's Uncle Sam on the right-hand side saying, "You can get busted for that." And that's sort of the way Social Security works. You know, we're always drawing on it. And interesting thing when you think about Social Security is that there are some difficulties with Social Security, and one of them is that we've got more people. You know, we've got as many people drawing as we have working, and that, you know, so the plan is a little difficult to maintain that way. But almost everybody who ever worked is going to get Social Security. You have to have 40 quarters, and that ends up being about 10 years to qualify for any benefits. And then they take your 35 highest years, okay? And so then they take it, and like I say, it's taxed to the annual maximum. So what I mean by that is when you are making money either as an employee or as an owner or dentist, you're going to pay Social Security tax up to $128,400. Now, the thing you want to remember is there are two parts of Social Security. There's the old age and survivors, which is basically the pension part of it, and then there's the Medicare. Now, what they did with Medicare a number of years ago is they said, we're taking the cap off. So I might pay $128,400 for the old age and survivor and Medicare, but even once I hit that, I'm still going to pay for the Medicare tax no matter how much we make, and that's for earned income. So if you have rental income or income from an S corporation or things like that, not the case. But so we have that. And then if you're self-employed, see, if you're an employee, your employer pays half and you pay half. If you're self-employed, you're going to pay both parts of it. Okay. And then you have to work and pay into the Social Security system. In 2018, you get one credit for $1,320 of earnings to a maximum of 4 credits per year. So a lot of times we have spouses on the payroll that don't otherwise work. And we do that for a number of reasons. Sometimes we want to fund a retirement plan, put it on the 401k or whatever. But the other reason we do it is we want to get them credits for Social Security. Now, chances are that if he or she is not working and they live to normal retirement age and there isn't any disabilities or anything else like that, that spouse will do better drawing on the doctor because they get half of their benefit, where their own benefit might not be very much. But if a person becomes disabled before regular retirement age, okay, they don't qualify for Social Security on their spouses. That has to be done on your own. So we like to have them make at least some money, so if they do get disabled, they can get the benefit. And then after 2 years when they're on disability, then they qualify for Medicare. So you look at that. So most people are going to need those 40 credits, 10 years to qualify. And then if you qualify under a different person's benefit, so if like your spouse. Now I have a client where it's a second marriage for both of them, and the wife can either collect on her own. She was married to the other husband for 10 years, so she could collect on him, or she can collect on the new husband. So it's interesting that way. So you get the higher benefit, okay? So for example, a spouse that qualifies for his or her own benefits would qualify for spouse benefits as well. And it's pretty simple. You get, what is the benefit for you? What is the benefit for me? Now, there are some restrictions on when they can take it, but assuming they go to the normal retirement age, this is a good story. In fact, there's a lot of planning that we do now, and we're going to show you in a minute, about the fact that the longer you wait to take your Social Security, the bigger the benefit is. Well, this works very, very well when we wait for the highest earner to draw it to age 70. Typically, it's the husband, and typically the wife is going to live longer. So when he dies, she'll get 50% of the benefit he was doing. So I might say $3,500, $4,000 a month that she would get because she takes over his benefit. So there's some planning there that can be done. So there's an issue here. Years ago, you couldn't make any money until you got to be age 70 and a half, or you started losing your benefits. Well, back in 2000, they changed that and said, if you're over 65, between 65 and just 69, okay, you can make as much as you want and still take your Social Security benefit. So there's another planning thing you got to look at. Should I take my Social Security at 66, keep on working, and get those benefits now? Okay, and so you look at, there's some earning limits in that year when they are 65. We're not going to bother going through that because it's a little complicated, but there are 3 magic ages for Social Security. The first one is we can draw a reduced benefit at age 62, okay? And that generally is 70 to 75% of the full retirement benefit. If we take it between 66 and 67, depending on where you come on the age story, you can get 100% of the full retirement benefit. But if you wait to 70, that benefit goes up to 132% of the baseline. So take a look at it. It has to do with when you can get full retirement is what year you were born. Now, I was born, I know you're going to find this hard to believe because I sound, and if you saw me, you look so young, but I'm in 1955, so I would not be qualified for full retirement benefits until 66 and 2 months, okay? So we look at this in the planning to decide what's the strategy, what should we be doing? Can we, I can sometimes work a client where we'll take it at 66, but we'll just take that money and invest it for those 4 or 5 years or whatever they're going to continue to work. You throw it in investments, and sometimes you could be ahead of the game. And you have to run the numbers, okay? So let's take a look at a couple of quick case studies. We've got a married couple here, and they're both born in 1960. We expect them to live 85 years. The husband made about 100,000 a year. The wife made about 40. So if they both claim at 62 and they live to their expected age, his benefit would be about 1771. Hers would be 1,038, and they would get 931,000 if they live to that 85-year age. Now, if they wait till 67, then they're going to get another bump in the amount they get. He's going to get 2,530. She's going to get 1,484. And if they both wait till age 70, they're going to be at 1,138,000. He'll get 3,137. She'll get 1,840. Okay.
Ted,
so you look at
does that work? Does that work because I think they compounded 8% annually?
Yes. Every year the benefit goes up 8% till you get to that year 70.
Yeah.
There's no reason not to take it after age 70 because it doesn't get any better than that.
Right. And
okay?
my calculus for this is you'll if you live long, you'll win the game. Social Security is kind of like hoping, like, hate to say it, that you'll die young, and if you defer, obviously they're keeping the money, and with net present value, that's important, and they need every penny that they can keep as long as they can keep it. But really what you're banking on is you're going to live longer than the mortality tables.
Yep.
And also, I mean, the way I look at it is if I have alternative sources of income initially when I retire or graduate, I might as well draw those down and let this continue to accumulate and hope that I live long enough to benefit from it.
Those are numbers that have to be calculated, but you very well could be right. Let's take a look at case 2. This time, we've got a little different situation. They're both born in 60, but the husband makes 250, wife makes 25,000. And my suspicion is this would be like a client of ours where we have the dentist making about 250, we have the wife on the payroll, maximize her 401k and whatever. If they both take it at 62, they get 959,000. His benefit is 1920 a month. Hers is 947. Now there's something to take advantage here. If they're going to take it at 62, they got to stop working because you can't make very much money or you'll start to lose that benefit. So you might make 10, 12,000 bucks a year. So that's another factor to look at it. Okay. If they wait till 67, they're up to 1,098,000, and if they wait till 70, they're at 1,117,644. So that's the optimum. What we sometimes will play this way is, okay, we have the husband claim at age 70, wife claim at 67, and we get the most bang for our buck. And plus she's getting it for 3 more years before, and we have that money to play with. Okay. Case 3, same kind of a deal. Husband is making 250, wife is making 25,000. Husband claims at 66, wife at 62. They're at 1,003,000. If both file it at 66 and 67, they're actually, believe it or not, less at 1,296,000. And if they both claim at 70, they're at 1,441,000. So there actually is. We actually work with some software to kind of play this out and see what's the best. But there's something you can't control, and that is, I want to go now. Okay. I don't want to wait anymore. I want to get my Social Security. My dad only collected it for a year. I want to go. So you have those emotional issues that go into there as well. Okay. Now, one of the things people talk about all the time is Social Security, the solvency of it. Now, Social Security assets are held in the trust fund. Interestingly enough, a couple of weeks ago, 4 years ahead of what they thought they were going to have to do, they have had to start invading the trust fund because the beneficiaries or the benefits that we thought we were going to have, they have now exceeded that. So I expect that with the action-packed Congress and president that we have, that within a couple of weeks we'll have a new law. Okay, you don't believe it either. Okay, so we know this trust fund is funded by payroll taxes and then earning on government bonds. And so before this last thing just a few weeks ago when they started taking it out, it was going to be fully depleted by 2034. I'll be gone, but my kids might get screwed. I'm not sure. We'll see. But bottom line on this is that something's going to happen. They're going to have to change it. So that means in 2034, they're only going to have enough funding into the system to fund about 77% of its obligations. So we take a look at this and say, okay, what can they do? Well, they've talked about increasing the full retirement age. People are getting older. You know, when they put Social Security back in, back a long, long time ago, the life expectancy wasn't that long. Okay, the average person when they first had it, the first 10 years, I think drew for an average of 3 years. One of my best friend's dad passed away on Good Friday this year. He was 91, still working full time for the Walmart, and drew Social Security from age 62 on. Okay, that's the kind of thing we're seeing more and more of. So they could increase the retirement age. They might say, okay, we're going to make the young or the early age instead of 62, they'll do it at 65, and then take the full retirement up to 70 or something like that. Now, the other thing that they could do is they could increase or remove the taxable wage cap. So just like they did with Medicare, they're going to say, you're going to pay Social Security on every dime you make, but we're going to freeze the benefits. So where in the past, when you paid in, your benefits were figured on what you paid in. Now you're going to get to a place where that doesn't work. And then they could increase the amount of Social Security tax. Now, the good news is that in America, we have the tendency to elect cowards. And cowards don't want to make the tough choices. But this is a tough choice that eventually is going to have to be dealt with. They're going to have to do something. And I guarantee you, it's going to be something that somebody or most people don't like. Okay, you're going to have that. You know, you're robbing from little old ladies. Now, that's the biggest myth in the world. Senior citizens probably have more expendable income than 35-year-old married people with kids. So, but it's still politically expedient to keep the program in place, but they're going to have to do something. I don't care who you talk to. They'll all agree with this. Just don't take mine, you know, and that's the kind of thing that we see. Okay. And I suspect we're also going to have means testing. So you're going to get a basic benefit up to a certain level that you'll always get. And then if you qualify for additional benefits, you'll have to prove that you need them. So, I feel good because the government knows how to spend my money better than I do. So it's, you know, it's important that way. Okay. So there is a great calculator on SSA.gov, and SSA.gov is a great website. It's very, very useful. You can go in, you can set an account up, you can find out what your benefits are going to be, you can play with the benefit calculator and things like that. And by the way, probably for a federal agency, the Social Security Administration is probably one of the best run agencies out there. They're very responsive. They deal with you very well. Their website makes it easy to file for benefits online, the whole bit. So, okay, we're going to get in and look at some retirement planning examples. We're going to get back here and talk about information needed to make the decision. You know, we got to know what you got in current savings. What else do you have? You know, we're going to sell the practice. How much do you think will net out of that? And then if you own your building, are you going to sell that or stay on as a landlord? And sometimes staying on as a landlord can be a better financial decision than selling your building. And we just have to do the numbers on it. And so we start looking at the liquid assets that we have and the invested assets, and then the personal assets, which in this calculation, the personal assets, the house, the cars, the motorcycles, the boats, they're meaningless, except that they all add cost to your monthly story. Okay, and what do you have in the retirement plan? Okay, so and then liabilities. That's another important part of the story. So we usually like to break down the liquid assets, and when we're in retirement, but normally, okay, we want to have in everyday normal story, we want to have between 3 and 6 months of liquid cash available so that if something happens, you can pay the bills for 3 to 6 months. When you retire, between your various accounts, in your retirement plan, in your savings, whatever, we want 2 years that resides in liquid cash so that you don't have to sell into a down market. Okay, does that make sense? I see you nodding your heads. Good. Okay. This is hard to do with a webinar. You don't have people that you can pick on. So, all right. So you get your liquid assets, then we get your investment assets. And we're looking at the stocks and mutual funds that you own, the closely held stocks, the bonds, mutual funds, all that good stuff, certificates of deposit, or as I like to call them, monopoly money, because they're not worth much right now. So we got, but those are the assets that we're going to have, excuse me, that are going to fund your retirement. So we want to know what those are. Okay. Yeah, the personal assets, we'll figure out what they are. I mostly want to know what they are so that we can identify, excuse me, I'm so sorry, what it's going to cost to maintain those things after you retire. Okay. So then we get the personal assets, and then we talk about retirement plans, IRAs, 401ks, if you have a company pension or profit sharing, all those assets, and calculate what we have for those. Now, it's equally as important to have a sense for where we're at liability-wise. Now, the thing is in my parents' generation, man, to retire and still have a home mortgage would be considered a failure, okay? But nowadays, I would think somewhere in the neighborhood of 60–70% of people still have a mortgage going into retirement. Sometimes they have two. They got a house and they got a cottage, or they got a house and a condo in Florida or whatever. So we got to know what those liabilities are, because that might mean that we got to look at debt reduction strategies. If we're 5 or 10 years away from retirement, it'll be much easier for them if they don't have this burden of liabilities. Now, if you ever listen to Dave Ramsey, there's the devil and then there's debt, and they're both about equal in his estimation, right? But as you get older, there is some benefit for getting rid of some of this debt. So we want to look at that, and especially if you're still running credit card balances, where I don't mean where you pay off that balance every month, but where you're never quite paying it down. That's the biggest sucker's bet there is in the world. So we want to make sure you know that. All right, now let's take a look here. We get your personal net worth. Now, sometimes I want to talk a little bit about the various stages of retirement, and this is based a lot on people that I have observed. Sometimes we'll have what I call the pre-retirement, or that period of time where we are working part-time, not totally retired yet, maybe waiting for our spouse to retire, or we're not ready to totally quit, or I was thinking of the guy whose practice I sold. He was 68 when I sold his practice, went to work for the buyer that bought the practice, worked for him for 11 years. Then he sold the practice to somebody else. He worked for that person for another 22 months or something like that. So he liked it. He was having a good time. So, at this stage of the game, you might be practicing 2 to 3 weeks, probably less weeks a year than you might have before. You take longer vacations in more frequent intervals, okay? You might be wrapping things up like the sale of the practice or the house or, anything like that, and kind of go that way. Now, the next group of years, and they can be between 60 and 75, but what I tend to look at is the 10 to 15 years after you're totally retired, okay? These are your high spending years, okay? You're going to spend, this is when you're not working at all. You're maintaining maybe a couple of houses, or a house and a large boat, or something like that. And then you've got extensive traveling. I didn't say expensive traveling, but I should have put both, right? Because it's both extensive and expensive. But what did you work all these years for? I had a client call me up last year, and he said, Ted, I'm going to take a trip, and I'm going to take my kids. It's going to be $30,000. I said, congratulations. He said, well, aren't you worried about it? I said, no. You got enough money. You can do this. Sometimes people forget why they spend all those years accumulating dollars, that especially those that are very conservative have a hard time actually spending some of it. And, I was, say, look, either you'll have a good time with it or your kids will. One of the two. And they won't have one regret in the world. Okay. I remember when I was doing an estate planning talk one time, my son Ted, who's now my partner in the investment business, I said, I have a goal to die with just $1 left. And my son said, Dad, we have different estate planning goals for you. So you got to look at that. And traveling, health is usually pretty good. You're physically active. A lot of times the stress goes away and their life gets really good. And that lasts sometimes 10, 15 years for most people, okay? Then we get to 75 to 80, somewhere in that range, and it's not exactly, but it's in that neighborhood, where you either don't want to or can't afford the two homes or the expense of the boat. Most of the time, it's not that you can't afford it, at least the clients I've looked at, it's that you don't want the grief anymore. You don't want the headache of doing it. When you're traveling now, it's a little harder. And if you've ever traveled, some of the places in the world are not that friendly if you have limitations, whether you're in a wheelchair or something like that. So they just get to the point. It's not that they're on death's door. They're just, the hassle of doing some of this stuff isn't as much fun anymore. So they limit their travel. Health's still pretty good. They're seeing their doctor a little bit more often. But generally, the important thing is they can live on their own. They don't need any care and things like that. And that's something, by the way, that's a whole nother topic. But you've got to consider what happens if I can no longer take care of myself. Your kids live in Denver and Dallas, and you're up here in Michigan or in Indiana. How are they going to manage that? Okay, so you got to kind of think about that. In fact, one of the things that I recommend my clients that they never take this advice, and that is sit down and have a serious heart-to-heart talk with your kids about how much money you have, what you're doing with it, what it costs you to live, where all your accounts are, who your key advisors are. They never do it, but we always tell them to anyway. So anyway, but generally what happens in these years is, except for medical, their expenses are less, okay? Now, when they get upwards of 80, and sometimes now I'm starting to see it 85 or older, where they can no longer care for themselves, or they don't want the responsibility of maintaining a home. Sometimes they'll go into an assisted living environment. They're still pretty spry, but they can't take care of the yard anymore. They can't do all this kind of stuff. Travel is much more limited, even like to go see the kids. Sometimes at this age, they'll send the kids plane tickets and say, come and see us, because it's just too much headache to travel for us anymore. They tire easily, and their health begins to fail. We have some friends in Florida, a couple of doors down, and they're 15, 18 years older than we are. Now, what we found out with them is they're really fun people to be with, seriously, but you can't ask them to do two things in the same week. So we call them and say, hey, Don, you want to go to lunch today? Yeah, that'll be good. So then we'll call them up and say, hey, Don, next day, hey, Don, we heard this band is playing over such and such. You want to go? Oh, no. We're kind of all in from yesterday. So that tends to be a mental story that they take on. And with the exception of medical expenses, we start to see expenses actually go down. Their desire to replace that car more frequently, or to buy furniture or do anything, is just sort of like, no, I'm pretty happy with this, and away they go. So now we're going to get back.
And that's a psychological thing. They're just conservative because they're not accumulating anymore. They're kind of afraid that they're going to be dipping too much into their
not necessarily. I think, especially people that are 15 or 18 years older than I am, so that puts them in their mid-80s or somewhere in that neighborhood. They were raised that way. Okay, they were raised in a generation where, it was a big deal for my grandparents to drive to Florida when they retired. That was really, took them a lot of thought and so forth. Now, gosh, I fly back and forth a dozen times a year. So different attitude. But generally, it's kind of funny because everybody in this plan says, I'm going to live it up. I'm going to have a good time. And if there's anything left, the kids can have it. But the reality is, most of the time, they're thinking in the back of their mind, they want to save a specific amount that they know that they're going to be able to leave to their kids. So you have to look at that as a possibility as well. Okay. We put together a couple of examples. These assumptions and the contributions and all that, are sort of different. Investment strategies and investment returns might not be constant. So what we do is there are a lot of good financial calculators out there, but to do this, we have to know the rate of inflation, the rate of return, the years until retirement, the estimated retirement expenses in today's dollars, okay, an idea of how much Social Security you're going to get, if there's any other pensions, and then we calculate what is the future value of the retirement income that we need. And then we calculate the present value of the money at retirement, and then we calculate the future value of the money that we have invested right now, And from that number, we figure out how short we are. Well, that's really nice to say, but maybe if I show it to you, it might make a little difference. Now, I don't know how small this is on your screen, so I'm going to sort of read it to you. It says, we have a rate of inflation of 3%, and we expect 28 years till retirement. And our current estimate of in today's dollars, we need about 160,000. Now we figure we're going to get about 30,000 in Social Security, so we've got to make up the difference of 130,000 from our investments. Now we're going to take that 130,000, do that financial calculator whiz bang stuff, and find out what will that $130,000 turn into based on that 3% of inflation 28 years from now. And the answer is it's going to be 297,431. So we have that 297,431, and then we start looking at the return that we get on our investments. We're using 7%, less the rate of inflation of 3%. So we have a real gain of 4%. And our life expectancy is about 35 years from retirement. And so when we do all that calculation, we figure we got about 5,551,000 that I will need in retirement. And actually, this is a number of our clients. If they're young, that's where we're coming up with. And then we say, okay, so we need 5,500,000, and we only have 250 grand put away right now. So we figure out at 7% interest, what will that 250 grow to? And that comes out to 1,662,000. Now that's not assuming adding anything to it. That's just if it just continue to get that 7% return. So now we got 5,500,000, we got 1,662,000 that we're going to get from the assets we already have. So we got a shortfall of 3,889,218. And when we do that, our annual contribution required to cover the shortfall is $48,000 a year. Now, believe it or not, for a young dentist, if they're making halfway decent money, that's doable. Okay. But the next example, this guy, by the way, was 37 years old. Okay. Now let's take a look at the next one. They're 50. We go through the same calculations, do all the present value magic and all of that kind of stuff. And now at age 50, he's only got 15 years, or she, till retirement. And so we have to put away $95,000 a month. Now that's a little bit more painful. Okay. Yeah, 95,000 a year. I'm sorry, not a month. And then if they're 60, okay, and the only thing that we've done differently, I'm sorry, the last one I should have told you that too. He had 500,000 already. Okay, now at age 60, our doctor's got $1.5 million, and so we go through this process, and to get where he wants to be in 5 years, he's got to put away $141,860 a year. Okay, now believe it or not, we have some clients that are putting away that kind of money. But the key is a lot of them that are doing it have been savers and good at their money forever, and they don't, they don't need the money to live on. Their lifestyle hasn't changed that much, so they can do it. But a lot of times when we get to this part, we start asking the question, is this realistic? Can you do this? And we might adjust it and say, well, okay, what if we wait instead of 5 years, maybe 7 or 8 or whatever, and we start playing the numbers to see if we can find something that'll work. Now, we get into those income producing assets, you'll see that, it goes up, for a while, and then it comes down. This is a table showing the same thing. And a lot of times when we're dealing with the client, we're putting this in with an inflation adjustment for the so we might start the first year at 150,000 and then adjust the drawdown every year for inflation. So the thing that I always try to tell people is don't let that first go at it depress you and say, oh, I'm not going to do anything then. Because even if you don't reach that goal that he had, you're still going to be better off if you've got 2.5 million instead of 3.5 or whatever. You're still going to be better off. Now, before you stop working full time, you got to go through these calculations, and when you find out you're not going to reach your goals, what are you going to do? Well, you can sit down and say, well, we had talked about buying a place in Florida or something. Maybe we'll just rent one for a month, a year, or something like that. We have to make choices. What's important to us, okay? And so we save and invest more now until you can afford it. Maybe we take a little bit more risk, investing a little bit more aggressively, and then maybe you delay retiring, even if you're not funding your retirement plan anymore, but you hold off 5 years. Let's say you can work part-time and not have to touch the retirement. That can have a big impact on the dollars we're talking about there. You can work part-time, work as a dentist, or work doing something else. You can move to a cheaper area or downsize your house. You can sell non-income assets like land that you're holding or a vacation home or things like that. Or you can always marry rich, win the lottery, or inherit money. Those are some of my plans, Then let's take a look here. What do you do when it's too late? Well, you can live on less than you expected and reduce your expenses. Again, we already talked about maybe more aggressively investing, but by the same token, if you're short on getting there, you got to be careful. You can't afford to lose by going too crazy with your aggressiveness in the investment. Downsize your home. Sometimes that's a good program. Sometimes it's not. If the house is paid for, that might be the cheapest place that you can live. So you have to look at that. Don't like this idea, but some people are forced into a borrowing from their home or doing a reverse mortgage. You can borrow from friends or family. They like that. Okay. I have a client right now, and they're okay. They're doing all right, but one of their mothers is loaded, and it's the wife's mother that's loaded, and she has an expectation of getting a very nice inheritance. So that might work out for them. And so, again, you can always dream, marry rich, hope to win the lottery. Now, I think it's very important to understand that about precision. Nobody knows what the future holds, okay? You and your spouse may pass away earlier. You may end up in a nursing home. You might strike it rich in a business venture, win the lottery, get an unexpected inheritance, okay? Nobody knows for certain what your expenses will be. And that's why, once you put this plan together, there is some need to go out and do a little monitoring of it every year so that you can kind of tweak things and keep it going in the right direction. Inflation and taxes won't be constant. Risk and rates of returns won't be constant. The numbers in the reports are just, they're just guesses right now. They're not predictions. Okay, let's just put it that way. And then Social Security benefits could be reduced. I don't believe that because, like I say, we hire cowards to run our country, but you might be paying a lot higher taxes, though. But the goal is keep your eye on the ball, see what's going on, spot trends, and kind of go from there.
Speaking of that said, I just want to let you know that we have 15 minutes to go in the presentation. That would include time for Q&A.
Okay. Let me just take a quick look and see how many I have and what I'm going to cut out. I'm going to go to the retirement plan choices. The cash flow part of it, there's a lot of things you can do in your practice and in your personal life. Anybody that wishes to have a copy of this outline, if you just send me an email, I will see that you get a copy of it. Actually, I'm lying. My assistant will see that I get you a copy of it. But let's take a look at our retirement plan choices. So let's bear with me a second. Okay, so we're talking about qualified plan choices. Darn it, I saved too much money for retirement, said nobody ever, okay? No harm will come to you if you overshoot the runway and you end up with more money than you thought you were going to. So when we look at how we're going to fund it, we look at tax implications, funding levels, withdrawal rules, how the investments are going to be set up. Now let's talk about first the IRA and the Roth IRA. Now the funding limits are exactly the same. If you're under 50, you get $5,500, and if you're over 50, you get the geezer pleaser with another $1,000. Okay. If you're in a traditional IRA, you get growth until you take the money out. If you put it in a Roth, you're going to get growth. You're not going to get any tax deduction right now, but you're going to never have to pay tax on the income on that. I always tell people never's a long time. God knows if the Congress changes their mind, but we can only go on what we know in the tax law now. And then when we withdraw out of the regular IRA, you get an ordinary tax rate. If you're out of the Roth, you get no tax on it. On the regular IRA, you have to start taking money out of it when you're 70 and a half. You never have to take money out of the Roth. That's one of the beautiful parts about it. So sometimes when we're looking, and I'll show you a little bit further down, sometimes that's where we leave the little nest egg for the kids or the grandkids, okay? Now, the problem why a lot of people can't do IRAs or even Roth IRAs is that, let's say, for example, you're covered by a retirement plan and the amount of money that you make limits whether or not you can take a deduction for an IRA. So if you're single, it starts at 63 and ends at 73,000. If you're married, it's 101 to 121 if they're covered, so you go from there. One of the main reasons a lot of times that we like Roth is we've got a few strategies that if we can't deduct the regular IRA, we got to end around or work around on that we can still get the money into an IRA. So we're going to talk about the Roth IRA conversion, okay? Traditional IRAs can be converted to a Roth by paying the tax on the gains in excess of the basis, okay? And so a lot of times when we're doing planning with clients, especially as they get into retirement and their income is much lower, we might start taking some of the Roth every year and putting it over into the regular IRA, putting it into the Roth so that we have less that we have to take minimum distributions on and so forth. So you establish basis by putting money in the IRA, and we make it a non-deductible IRA. Now, the income limits sometimes don't allow us to go directly to the Roth. Instead, we got to do this little game. So if we have it, we put it in a non-deductible, then we can roll that from the IRA into the Roth IRA. It's called a conversion. However, if you have other IRAs, that's going to cause you a problem because let's say I've got 100,000. In fact, I think I got an example here, so stand by and I'll show you it. So you want to consider this non-deductible IRA to establish the basis and convert. Let's take a look. Here's a case study. Client has $95,000 in a traditional IRA with no after-tax basis, okay? The client funds a non-deductible IRA for $5,000. So now we have 100 grand. And so if we were to convert some of it, 95% would be taxed and 5% would be no tax. So we would pay tax on the 95% or $4,750. But there is a better way. And what we would do if we're in this circumstance is before we do this conversion, we roll our IRA into the 401k if we have one, okay? And if we're not the employer, not only do we have to have one, but it has to accept rollovers from IRAs. Most of them do, but so what we do is we get that IRA right off of our books, and it all goes into the 401k. Now it removes all of those pre-tax IRA assets from the conversion calculation. Now we make the non-deductible contribution to the IRA, which we now have the basis in, and the IRAs, the simple IRAs, all of those are considered pre-tax. And so we get a beautiful thing because we do this. I have some clients that we do this every single year. Well, actually, once we made the conversion into the, got all the old IRAs into the 401k, it works very, very nice. So it's a way to go around the transit, so to speak, in getting us to be able to fund Roth IRAs. Because often we're out of the game because we make too much money. Now let's talk about employee-sponsored plans, and we'll start talking about 401k plans first. Now, we have highly compensated employees and we have non-highly compensated employees. And the highly compensated employees are always, no matter what they make, the owners and their family. And then the non-highly are generally making less than about 80 grand, I believe the number is. So it factors into the calculation of what we can put in. So in a 401k plan is nothing more than a profit sharing plan that we've added a 401k provision which allows us to defer money into the plan in addition to whatever the employer puts in, okay? And most of the plans that we deal with, we're going to elect to have it be what's called a safe harbor plan. And the safe harbor plan says to us, look, if you agree to put a certain amount in for the employees, typically 3 or 4%, then you can put all you want to up to the maximum for your deferral. But if you don't go safe harbor, then you're only going to be able to do 20% more than the employees. Well, I can tell you right now, you all know this as well, your propensity to save is much greater than your employees. They'd rather have the quarter an hour, so you have that to deal with, okay? And then we have a safe harbor non-elective, which is basically another method. When you have a 401k plan, there are testing. We have to make sure that we're covering all the people that we have to cover. When we have a young doctor, and this happens with some frequency, buys an older doctor's practice and gets going after a year or two and decides they want to fund a 401k, the problem that they have is that everybody in the plan is older than the doctor. And so what happens is a lot of the plans that allow us to do some legal cheating on behalf of the doctor deal with the fact that he or she is older than the employees. So what we do have, though, for the young doctor is what's called the Social Security Integrated Plan, which basically we get to put a little bit more in for the doctor because Social Security is going to be less meaningful to them than it is to the employees, so they get to kind of make up the difference. Another one that we love, if the demographics work well, is a cross-tested or what's called a new comparability plan. If I've got a doctor that is older than at least a few of their employees, we can really put more in for the doctor and not hurt the employees. Now, you have to have a plan document, and those are done by people that are smarter than I am, I think. But so let's take a look at some of the plans. Now, we can start with a SEP IRA. Now, we've got to cover anybody who's been there 3 of the last 5 years. They're over age 21 and they've made more than $600. Okay. The funding by the employer is the same percentage for the doctor as it is for the employee. So if doctor decides to put 20% in for herself, then she's got to put 20% in for the employees. Okay. This works like anything else. It's pre-tax. When it comes out, it's ordinary tax rate. Very little, if none, administrative cost. And it's the best when I've got like a doctor that is a self-employed associate or something like that. They don't have any employees, so they can put a boatload in. One of the things that's kind of cool about SEP plans, it's the only plan that we have that you can establish after the year end. So I've had clients come in mid-April, or just before the filing deadline, and they made some money, and they're looking at this and going, what am I going to do? And we dig into it a little bit and find out they qualify to fund the SEP plan. We can establish it any time between then and the due date of the tax return, and then fund it at that time. So a very cool little program that works. The problem with SEP IRAs is that once we start getting everybody on board with us for about 3 years, they get mighty expensive in terms of what we have to put in for the employees. The next logical step up for the doctor is a simple plan. And we do put a lot of young doctors in simples. We have to cover people that have worked 2 of the last 5 years and made a minimum of $5,000. Now, if the doctor just bought the practice, if he decides to let himself in the simple plan with only 6 months on the job, he's got to do the same thing for the employees, okay? So the employer contribution is pretty simple. It's either a 3% match, dollar for dollar, or a non-elective program where we pay 2% for everybody. I would say almost every simple plan I have, they do the 3% match. Now, then they also get to put a salary deferral in, 12.5 if they're under 50, 15,500. So this is one of the things we look at funding. If doctor's not going to fund much more than 20 or 25 grand, this is where they belong. You know, it isn't worth the extra expense for the 401k plan, and so we will be in better shape to fund the 401k. Again, same rules that as taxation and so forth. Now, the one little hiccup to this is the funds must be left in the account for a minimum of 2 years. And this works really well for young, new practitioners, but we look at it as a bridge program. It's a year, 2, 3. I've got one that we talked to last year. We should have probably put her in a 401k, but she was a little concerned about being able to hit it. Well, we're going to be putting a 401k in January because she's doing quite well. Okay, in a 401k plan, we have a little bit more design. They have to work over 1,000 hours for us and at least a year. They have to be over age 21, and we can have employer contributions, and we can have the salary deferral. Again, the salary deferral is at 18.5, 24.5 if they're over 50. If we have the safe harbor, chances are we're going to put 3 or 4% in for a match. And there are a lot of ways, different little tweaks that you can put into these. Now, a doctor making decent money and have a spouse on the payroll could very easily get 75 or 80 grand a year into this plan. So that works nicely. Okay, let's take a look at the doctor has an $18,500 salary deferral, $11,000 4% safe harbor contribution. They make a discretionary profit sharing contribution of 25.5. So doctor, we're putting in 55,000. This is a pretty typical scenario. Spouse is on the payroll. She's not 50, neither is he. They put 18.5 in. We get to pay her for the 4% as well. And what we can elect not to do the contribution for her, she gets 19,000, and then you'll see what happens with the employees. Now, when we're looking at one of these, we're looking at, okay, what's the total that I got to put into it? What's the tax savings I'm going to get from the total from everybody? And is it going to cover the employee cost? And when you get to 401k, you're going to be paying somebody to do some administration, a couple $1,000s a year. So we have to look at it and say, hey, is there going to be enough of a savings to make the juice worth the squeeze? Okay. Now
at this point, I just have to remind you again, Ted, we are just about finished and out of time.
Okay.
So I'm going to have to ask you to wrap it up, and
okay,
you may have to. I know your information is great, and we probably won't have time to get to anybody's questions as it is. So if you could just try to wrap it up, and maybe we can.
I'm sorry, I went a little bit crazy with the information I have for you, but
well, it's a lot of information, and it's valuable. There's no question.
I think the key is that you want to, to get involved in some kind of a plan and work your plan. That is something that's real important. You can do Roth deferrals in your 401k. I want to remind you of that. And then for those of you that are in other parts of the country, I am a member. I want to show you one thing real quick because this is cool. Let's say you got money in an account in your IRA, got $100,000, we've got a 10-year-old grandchild. If you leave it to them and you pass on, they get to take it out over their life expectancy, and as a result of that, they take very little out, and we build a really nice nest egg for them. So that's something real important. So we get into some of these other issues. Finally, I am a member of the Academy of Dental CPAs. If you're from other states around the country, there's some really capable people at the Academy of Dental CPAs. And so in addition to myself, they'd be very happy to help you. Here is my question and answer, or my contact information, telephone number, address. Now, we do have a special offer for those that either are listening on tonight or are going to listen to the recorded version later. We will do a complimentary customized retirement income projection, very similar to what you just saw in our examples. Absolutely no cost. If you want us to go over it with you, we will. If you just want to see it, we can do that. We're happy to do so. Those of you that have questions, call me or email me, and I'll answer your questions. Thank you so much for your attention tonight. I'm sorry I went a little bit over, but again, if you would like a copy of this outline, just drop me an email or call the office and we'll get one sent out to you right away.
Thank you, Ted. I think that only goes to show just how much value and content you can share, and I really do appreciate the offer. That's worth the price of admission, if there was a price of admission, and there isn't. So that's great. We will see that all of your questions are answered by Ted. We have made note of them, and we'll be forwarding them to him. So again, I want to thank all of you, and especially you, for that lively discussion. Just packed with valuable information. I'm sure our attendees agree with me. They now have a much firmer foundation on which to build a happy retirement. In a few days, you will receive an email with instructions on how to receive your 1.5 hour of CE credit. And at this time, I'd like to ask everyone to please mark their calendars for our next webcast, which will be on Thursday, July 26th at 6 p.m. Central Time. Our very special presenter at that date and time will be Ms. Diana Thompson, who will discover the operational equity in your practice and boost your bottom line. Ms. Thompson specializes in organizing, standardizing, and improving practice operations, patient and referral-based retention, financial growth, increased brand awareness, new business development, team building and communication, internal and external conflict management, acquisition to transition, the startup practice, credentialing, and compliance. In short, there's very little she doesn't do. She, in general, helps practices to see through the white noise to realize their full potential. So be sure to join us for this most special event on July 26th. In the meantime, this is Danny Bobrow, thanking you once again, Ted Schuman, and thanking all of you for your continued commitment to practice perfection. Goodbye, everybody.